Good afternoon, folks. This is Ben here. I want to talk to you guys a little bit today about some trends that has been unfolding and that I'm paying attention to. Okay, so we all know that the outstanding performance so far this year has been primarily in large cap tech and some other names, specifically the stocks that we call the Magnificent Seven. Now everybody's kind of stepping over each other to buy Nvidia and other semiconductor plays because there was the whole AI craze, and that has actually worked out quite well. But a lot of these stocks have stopped recently, and the valuations are just insane at this point. Also, global semiconductor sales is just not really picking up steam. So it's hard to argue for more stellar upside in this space now, at least. The Semiconductor Industry Association actually announced as recently worldwide sales of semiconductors totaled $124.5 billion during the second quarter of 2023, which was an increase of almost 5% over the first quarter of this year, but it's a 17% decrease in growth, okay, from the second quarter of last year. So I'll argue that this play is had its day in the sun and it's running out of steam, okay, at least for now. And last time I did this flash, I talked about crude oil and energy names, which has done really well. That's a space that continues to perform, but that too might be softening up a bit here. Overall, the markets have been sluggish, okay, with mixed economical releases, continued fear over interest rates being kept higher for longer than expected, which is clearly problematic. We also have seen some weakness of some various leading indicators. Today, in fact, we had the inflation report that came out just this morning, and it came in a bit hot, okay, at 3.7% versus 3.6% expectations. The market kind of took it in stride. It saw some volatility, but it didn't really lead to anything. And then you had the core inflation number, which excludes food and energy, that came in at 4.3%. And that's a deceleration from last month's number of 4.7%. So those two are a bit mixed, but sorry to say, food and energy is a huge part of people's daily lives. You can't just exclude it. Now, in fact, those two things are probably what impacts people the most now because of gas prices and food costs and everything else. So the fact that that came in a bit hot is a number that is going to hit the consumer. So then the question is, what other areas of the market are we seeing potential flows, positive money flows, but are a bit more under the radar? Okay, just not talked about as much in the media. Now, while we are fundamentally based traders, clearly, it also pays to really consider the relative performance and the trends in whatever stocks that you're looking at in either direction. Because I want to align myself with the prevailing trends of what's unfolding, not only in the particular name that I might be trading, but in the sector. So it's not about focusing on the overly hyped stocks that everybody already owns, like the Magnificent Seven. But where are the trends shifting? Where are the gears kind of starting to turn more from one side to the other? And we're starting to kind of see some momentum being caught up. It's kind of like a train that's starting to leave the station. That is the time that you want to jump on these some of these names. And right now, healthcare and drug companies really start to make sense on the long side, at least from my point of view here. Now, performance-wise, these stocks are in the middle of the pack, has decent outperformance recently. And, the Fed funds rates are stabilizing, most likely around 5.5%. But that's still really high, okay? And there's a good chance people will cut back on big ticket items. But they still need medicine, medical care, and drugs and everything else, regardless of what's going on with interest rates, the economy. In fact, the total U.S. healthcare spending totaled $4.4 trillion in 2022. And is looking to grow 5.4% annually, actually, through 2031, which is 1% more than expected GDP growth. So I have identified 20 stocks that I like in this space. You can see them on this table, and I have some performance metrics on there also. And you can clearly see that the performance numbers here are good, better than the overall market for the most part, but not extreme. This is kind of what you're looking for. And not only, we talk about performance, relative performance, not only percentage change over a past period, but also where are these stocks trading relative to their 52-week high range, which you can see on this table. Now, on average, these stocks are up 25% over the past 6 months versus 15% for the S&P 500 and 30% for the NASDAQ 100, more or less. So they are uptrending nicely, but not flying high by any means. Now, the valuations are up there a bit, but not too lofty, which is what you want. Like, you want valuations to be high to give you a multiplier that makes sense. Now, if you're trying to buy stocks that are so-called undervalued, very low valuations, first of all, it rarely works. And more often than not, the stock just doesn't go anywhere. All right, so these stocks have an average forward PE of 35, which is reasonable, not low, not really super high either. I took out Nari because that stock has not really any earnings, so it kind of skews the average as an outlier. So anyway, that's kind of the message here. Now, following the money does not mean just buying high momentum plays. Not far from it. We are looking to catch the early stages of a developing trend that are starting to unfold, but only if it makes sense fundamentally and combined with the macro picture. So, trying to buy stock, a lot of people look to buy stocks that are undervalued with very low PEs and whatnot. It might sound alluring, and it might work if you Warren Buffett want to hold something for 10 years. But if you're a trader like we are, especially with options, you need stocks that are on the move, go in the direction you want it to go, instead of just sitting there waiting, bleeding time decay, and just bleed to death. So that's kind of what you want to look for. Now, you have the greatest chance of success by staying with the prevailing trends rather than fighting it. That kind of makes sense, right? But it's amazing how many people don't do that. Another area in the market that I'm currently looking at is consumer staples. Same deal here. These are companies that make products that people need every day, regardless of what's going on with interest rates or inflationary pressure. Tough times or not, we still want beer, wine, food, toilet paper, etc., and other things. And there's been some good relative inflows in certain names that I'm not going to mention in this space that are setting up for some really juicy trends that I'm looking at. So the question is, why make trading more difficult than it already is? Don't look for the cheap deals and don't chase the euphoria that everybody talks about either. There's a kind of a sweet spot in the middle where things are starting to evolve, okay? But it's not fully ingrained yet. And that's kind of what we're looking for, where things are just kicking off and everything makes sense fundamentally from the macro side and also from the trading side. So there you have it, folks. That's all for today. Catch you next time.